Okay, it's 11 o'clock. Let's get going. There's not a lot to talk about this week in terms of news, but we are talking to Joe Bauernfreund of AVI Global Trust, and that's fun. It's been doing particularly well, so it'd be interesting to see why. But first off, news-wise, so the big thing this week is the merger of JPMorgan Midcap and JPMorgan Small Companies. So I thought I'd tell you a bit about that. Starting off then with just setting the scene a bit. So JPMorgan Midcap, it's been trading on a discount for quite a long time, and I think a wider discount it probably should have done, considering how liquid the underlying is. Because that sort of FTSE 250 bit where it's invested in is fairly liquid. The market cap isn't massive, so sub 200 million, and obviously that's consideration. And JMI, although that trades on a reasonable wide discount too, it has been narrowing that over time. Obviously, the UK small cap we know is very out of favour at the moment, and that hasn't helped. But it's a sort of a slightly bigger fund than JMF, and I do think it's got a good track record, which obviously helps. So, as with all of these things we've been talking about recently, it's a Section 110 scheme where one fund effectively gets liquidated and rolled into the other one, done on a asset value to asset value basis, accounting for costs, so formula asset value FAV. There is a cash exit option for the mid-cap shareholders, but only for 15% of the fund at a 2% discount to the formula asset value. So how many people go for that? I don't know, or might be taken before. But the default option is going to be rolling into JPMorgan Small Cap. They're going to pay out all of the income that's accrued on JPMorgan Mid Cap first before actually the deal goes through. So that will tidy up that revenue account. And then going forward, the newly enlarged fund is going to pay out 4% of its NAV each year. It'll split in 4 payments as an enhanced dividend. So something that JPMorgan funds have done quite a bit recently. The neat thing is that it keeps the same management team. So Georgina Britton and Cut himself, we talked to them on the show before. They run both funds. So from that point of view, it's really quite straightforward. Because they're getting on this new souped up income policy, they're going to change the name. So JPMorgan UK Small Cap Growth and Income, Juggy. These things are a bit of a mouthful, but there we go. And there was already a 3-yearly continuation vote in JMI, so that just carries on going. So if you're a mid-cap shareholder before, you didn't have a continuation vote, now you have a benefit of that. Because they've got to knock the 2 boards together, they're bringing 3 additional directors across from JMF. 7 is slightly unwieldy, I think, for £400 million fund, but there we go. We'll see whether it goes down to 6 in time. Part of the rationale for doing all this, obviously, bigger, more liquid fund. There's also going to be lower fees, so they're cutting the fee anyway, but the fee was tiered. So there's a clear benefit there that it's 0.65 in the first 200 instead of the first 300 million, so that's a clear saving. And then because the sort of fixed costs are spread over a smaller base, so a larger base, the ongoing charge to ratio is going to fall quite dramatically. They're saying to about 0.8%. We don't know what the costs of the scheme are yet. We won't know that until the circulars are published. But effectively, JPMorgan is chucking in about 550 grand by waiving its fees on the assets that are going to come across. And we know that that's going to be at least 85% of JPMorgan Midcap. Which is about, so £550,000. So in terms of the process, circular will be published in January. Meetings will be in February, and it should all be wrapped up in March, providing obviously that shareholders approve it. So I think it all makes sense. I mean, the thing that's been for a long time, people have said, we don't understand why JPMorgan Midcap exists. Why don't you just roll it into Mercantile? Mercantile is another fund that JPMorgan run. It's investing in the same sorts of things. It's more, actually, it's going to be more akin to JMI when it's, I think, done. but a slightly higher percentage in the FTSE 250. The performance of mid-cap and Mercantile has been fairly similar, although you can see the Mercantile is probably a little bit better. The performance of the small cap fund has actually been over 10 years, 5 years, well ahead of the mid-cap stuff. So that is obviously helpful. But there is an issue. Mercantile is trading a narrower discount than JMI, and I think they are going to have to be conscious of where the discount is. There isn't a lot of portfolio rationalization by doing it this way, because there is quite a big overlap between JMF and JMI, because it's got the same managers. Obviously, Mercantile's run by a different manager within JPMorgan. And I think they must have thought it'd be a really good idea to get JMI bigger, because that sort of 200 million-ish is sort of a bit neither here nor there in terms of the sector. Now, the only other question that's in my mind here is, what's the point of doing this 4% dividend thing? Does it actually make a difference? So I pulled out some numbers on competing funds that are doing this. So that's the Invesco Perpetual one, IPU, and the Montanaro one within the small cap space, UK small cap space. And I don't think it makes a massive difference to their ratings. So yes, they are a little bit tighter on the discounts than the NAV performance would suggest they deserve. So maybe it's helped, but it's not dramatic. If you look across the other sectors, so a lot of these are JPMorgan funds that they've been doing this. JPMorgan Global Growth and Income, obviously JGGI, is the sort of flagship thing. It's been growing, it's doing really well, but it's also the best performing one. So that's one reason why it probably trades on the narrowest discount. And the yield isn't particularly huge because it's been sort of performing quite well. The European one, it definitely doesn't seem to make a difference. And I think you go down there, so you've got Asia, China, small cap Japan. Yeah, none of these things sort of stand out. International Biotechnology has been doing it for a long time. That maybe you could say maybe that is working because it's got the narrowest discount in its subsector, despite ranking third of 7 over in NAV terms. But in the private equity stuff, there's a marginal benefit maybe, but it's not huge. And even where those discounts, the yields are even higher than the 4% they get for 5% in some cases, that doesn't seem to make a massive difference. So I'm not sure. I think because now income is easy to come by, and there are more options in terms of higher yielding funds, and we've got a lot of really big yields in some of the UK equity income sectors and renewable energy and infrastructure and that sort of stuff. I don't think these things are as sort of shiny and attractive as they used to be, but nevertheless, it's going to happen anyway. So I think it's kind of welcome, but I don't think it's entirely necessary. There we go. That's enough from me.